Time to go? Good morning, everybody. Happy Friday, happy Friday, happy Friday. Join me. Happy Friday, happy Friday. Hey, everyone online.
Good morning! No, just kidding.
Thank you for joining us for this morning's Around the Valuation World show. I'm Brian Jones, Chief Operations Officer for the NACVA and GACVA. I'm joined on stage this morning with other correspondents, Stephen White, Alina Rivera, who is our brand new co-host of Around the Valuation World, Melissa Gregg. Also online, we have Mel Abraham, who is our brand spanking new co-host of Around the Valuation World. And this version of AVW is focused on international concepts, topics relating to business valuation and financial forensics. In January this year, we launched an offshoot of AVW to focus on international topics, as the GACVA has been a growing association with chapters that we sponsor and support from a credentialing and membership perspective around the world. So the international segment allows us to expand our content and to reach around the world to support our global constituency. Brief announcements about CPE this morning. For those of you who are planning to earn CPE, please respond to the poll questions that will show intermittently through the presentation. For those of you joining us here in Park City on this lovely Friday morning, make sure your badge is scanned in and out so that we can comply with the standards for NASBA to issue CPE for everyone. 3 to 4 weeks after the conference, you'll be able to log into your account at nacva.com to download your CPE certificate. If you have questions for our guests this morning, if you're online, please direct your questions, actually type them, not direct, into the chat function in the Zoom dashboard. And for those of you here in the audience, if you have a question, just let us know, and one of these wonderful co-hosts will get your question posed to our guests so we can get your answer. Maybe I started off too high this morning with my happiness. So we're going to get right to it. We've got a great guest this morning representing India, Australia, Israel, Romania, Canada, and Spain. We're going to start with Dr. Sri Ramamurthy being interviewed by Pratik Shah and Apasik Shah, who both represent our chapter in India. Good morning.
Good morning, Brian, and thank you for the warm introduction. And it was really nice hearing you after a long time. I think it was the last AVW show when we all were interacting with each other, but nice to connect with you again, and really happy to interview Dr. Sri Ramamurthy. We are trying to bring him on board on one of the GACVA conferences as well. So hoping, it would be a great experience for all of us. So Dr. Sri Ramamurthy, before we start the interview, would you like to discuss anything as a starting point?
Well, I just want to say thank you for this opportunity. I want to thank Brian Jones, who I've known for many years, and absolutely a pleasure meeting you, Pratik. And I appreciate you considering me for a future presentation, even before hearing me once. So
I've been following you a lot, sir. So nice to get virtually connected in this new post-COVID era. So before wasting any more time, I'll just start with a few questions that we have, and would definitely like to hear your insights on a lot of theories and books that you have, I would say topics that you have presented. So first question is that you have written extensively about the human factor in fraud, even coining the term behavioral forensics to describe this emerging field. What is the importance of considering the human factor in fraud? We all know it's important, but what's the importance of considering the human factor in fraud?
well, I need to probably clarify to everyone that even though I'm trained as a chartered accountant from India and as a CPA in Ohio, Believe it or not, but my PhD is in quantitative psychology from the Ohio State University, making me the first and only certified psychological accountant, CPA, in the United States. So, I guess all of you should not be surprised that I obviously take a very behavioral approach to things. And so, some 14 years ago, I wrote something. Let me just read that real quick here. When I try to describe fraud in an article in Financial Executive, which is the Journal of Financial Executives International. And here is what my co-author Bill Olson and I characterize fraud as. Fraud is a human endeavor involving deception, purposeful intent, intensity of desire, risk of apprehension, violation of trust, and rationalization. Okay. And then, I looked at what I wrote and I scratched my head and said, I don't find a single accounting term in here. This is all psychology. And the aha moment struck me that fraud is more about psychology than it is about accounting. And so from that comes this realization that we have been focusing around the world on the instruments of fraud. What kind of accounting schemes are used to commit fraud? When you think of cyber fraud, how computers and technology can be used to commit fraud. But these are all mere instruments. We ought to go to the source here. Who is it that's committing fraud? It's one or more people. And so the people or the human factor is paramount. That's where we ought to be focusing. And that leads you very quickly to realize that the how question, how the fraud was committed, is less important than the why question. Why did one or more perpetrators commit fraud? What was their motivation? What got them to do this? And the simple answer, greed, we find is completely unsatisfactory. We need more than greed as the answer. Because when the fraud is committed by a billionaire and they're trying to make just $1 more million, it's not clear to me that they really need that $1 million. That's the 1,000th, of $1 billion. So what the heck? I mean, why are they spending their time? There must be something else going on. It could be, for instance, keeping up with the Joneses, parity with other CEOs or other rich people. And so even 1 billion matters because now you're the second richest man in the world, not the first. And so that kind of competitive, realization matters. So that's, another way to think about this. Most importantly, I guess I'll tell all of you, and it'll kind of hit you as pretty obvious. In almost every culture, we have this phrase, to think like a crook to catch a crook. So there is this understanding that we need to get into the mind of the white-collar criminal because that's how you figure them out. That's how you understand where they're coming from, where they're operating from. So I think that should be a good start to tell all of you that the human factor in fraud is absolutely and critically important, and ignoring that makes the study of fraud actually quite sterile and useless, frankly, as far as I'm concerned.
Thank you, Dr. Sri. Just one follow-up question. I think we are running out of time based on the time slot allotted, but I have one follow-up question on that. So you have also remarked that culture can be both an enabler and a driver of fraud. So how so? What role does culture have in creating fraud-resistant organization?
So culture, I like to think of it as consisting of the tone from the top, the mood in the middle, and the buzz at the bottom. So throughout the organization, what people do, what they say, how they behave, all that is part of culture. And we are really talking about the commitment and the orientation and the attitudes of the people in an organization to core values, to integrity, to excellence, these kinds of things, whatever the organization sets out to do. And so when that culture is toxic, it's not positive, then you may have people looking out on how they can make a quick buck or look out for themselves and not really the organization or its people. And that can very quickly careen into disaster. In fact, poor culture, toxic cultures can be a real problem because internal controls and anything else that you put in place are going to be ineffective because they're not addressing the people in the right way. And so the one thing about culture I can tell you is that Peter Drucker, the former management guru who's passed away since, said famously that culture eats strategy for lunch. Meaning, you can have whatever strategy you want, but if you don't have a good culture, that strategy is not going to be utilized or effective. So culture is absolutely important. Without culture, you have a bunch of rotten apples probably in the organization, and that's going to lead to fraud. One last comment. From my work in forensic accounting, and I used to, be with Ernst & Young's forensic practice, just from sort of the practice experience, I can tell you, they say, 10% of the organization might be wonderful people, so committed, so honest, full of integrity. These are the Mahatma Gandhis and the Mother Teresas of the world. Wonderful people, okay? On the opposite end, there could be up to 10% of the organization who are natural-born crooks. All they're trying to do is to make a quick buck. They are obviously in the wrong place, but that's what they're doing. And then there is the 80% in the middle. And who are these people? They are waiting and watching what the organization does with the crooks. And if they are let go with just a slap on the wrist, I think people start getting the idea, looks like I can get away with murder too, and nothing will happen to me. And so that's all, again, part of culture. So this is why it's very important for organizations to take swift, decisive action when fraud surfaces so that the message is very clear that the organization does not like this kind of behavior, and they, give that communication and deliver it very, very clearly.
Sure. So I think we are out of time. So thank you, Dr. Sri, for your insights on behavioral forensics and human factor. I'll get back to Brian to take it over for the next one.
Thank you, Dr. Sri. And also thank you, Pratik. For all those of you who are interested in learning a bit more about the psychology behind fraud and the forensics of fraud, with Dr. Sri, we're producing a Dayton Fraud Conference, October 20th through 22nd, with the Behavioral Forensics Group, the ACFE, Axiom Consulting, and University of Dayton. This will be another hybrid virtual conference that the NACVA will be co-producing this fall, covering cyber, ethics, and fraud. Also, the week of July 12th to 15th with the Behavioral Forensics Group, we're focusing on a webinar week, Bringing Freud to Fraud. It's More Than Greed. So we appreciate you this morning. Our next segment, we will have Morris Kaplan, who is an evaluation expert in Australia and Israel, being interviewed by Andrew Newman, representing our chapter in Canada. Good morning.
Morning, Andrew.
Morris, hello, good to see you.
Good morning, Morris. How are you?
Very good, thanks.
How are things in California?
It'd be nice if I was in California, but I'm not.
Okay. Well, the first question I have for you is, in addition to contributing as you do in terms of lecturing and so forth, how do you find practicing in other jurisdictions than your home jurisdiction? And which jurisdictions do you practice in specifically?
It's an interesting challenge, because obviously every country has its own standards, its cultural environment, its nuances. In terms of valuations as such, obviously the basics are pretty much standard across the board. There's clearly issues that are particular to each country. So, for example, Australia, which is where I do most of my work, is probably close behind the US. It's following behind the US. The US has always been, in my experience, in the forefront of the valuation profession by virtue of its size more than anything. But over the last, say, 10 years, Australia has really started to pick up its game in terms of things like accreditation. Also, valuations have become a lot more. And having said that, let me just backtrack a second. I know Canada's up there with the US, so not to insult anybody, the Canadians and the Americans seem to be ahead of the pack, but Australia's really developed pretty well over time. We, internally we have our own accreditation. I've actually been a member of the NACVA since from the last century already, 1998, when I realized I wanted to get ahead of the game, particularly in the areas of the small and medium enterprise market, because there wasn't a lot of sort of structure in that space in Australia. So we're coming along pretty well. In other countries, I do quite a bit of work in Israel now, but Israel has a very close relationship with the United States. So bizarrely, one ends up doing a lot of American work out of Israel because of the nature of the businesses here have such a strong relationship with the US. And I've done work in South Africa, which is quite similar to Australia, not quite at Australia's level. A very good sort of organized, structured accountancy and valuation profession. And I've done some work in Asia, which is different depending on which country you operate in. Of course, there's a language issue there. Most of my work has actually been in the Philippines. But yeah, it's interesting. It's when you have basics, I guess, and you do a valuation, it probably doesn't matter that much where you are in terms of the number crunching, but obviously there's other factors that are relevant.
Morris, I would imagine that the legal environment plays an important role as well for you. And how do you find being accepted as an expert in various jurisdictions with the designation that you have? Because, I would assume that that becomes a question, especially within the legal community when you're practicing.
Absolutely. In terms of litigious work, obviously, it's more difficult to work across jurisdictions because you need to have credibility and a reputation when you are involved in providing expert evidence. One of the valuations I do in cross jurisdictions are not litigious, so there'd be financial reporting valuations, for example, where the accounting standards become the critical issue. I've given evidence in Australia many times in the federal court, the Supreme Court, and the district court, but fortunately never given evidence and never had to give evidence in any other jurisdiction. And I'd like to keep it that way, to be honest.
Fair enough. In terms of the point that you were making about working in Australia and in Israel, an interesting piece of information is the number of Israeli companies that happen to be on the NASDAQ. I think they're more represented than any other foreign jurisdiction. So that may suggest that you have a lot of involvement in the United States in terms of valuations per se.
Absolutely. As I mentioned briefly before, the work that I've been doing here has been pretty much with United States, with businesses that have a lot to do with the United States, particularly in the financial reporting space. There's also, interestingly, there's a lot of Americans living here, and there's a fair amount of tax planning that gets done, obviously, in the United States, and valuations are required and are done out of Israel, to be honest, with the firms here that have a relationship with solicitors in the United States. So, it depends on the firm, of course. Some firms would obviously be very much focused on Israeli work. Depends whose practice it is. But the work that I've done here has been pretty much exposed to the United States market.
And for example, in Australia, are you finding that there have been major changes in terms of the businesses that you've been involved in migration, in terms of what are the more attractive areas to be investing in Australia per se, relative to what you see in the United States or in Israel?
It's interesting. In Australia, there's still a lot of work in what I would call traditional businesses. Businesses that have not really changed over many, many years, but obviously the IT sector is becoming bigger and bigger in Australia. And we're noticing over time that more of the work we're doing is in that sort of high-tech IT space where intangible asset valuation issues become pretty much very, very important. This is a fairly recent move in Australia. I'd say probably the last, when I say recent, I've been doing this for so long, you lose track of time, but maybe 10 to 15 years, we've seen quite a shift with lots and lots of IT companies becoming, a lot more prominent in our work. A lot of this is also because of the changes to the tax laws and also because of the nature of business. People offering, equity to their employees. Those things need to be valued. The Australian Tax Office looking more closely at movements in ownership of structures and transactions. So all that sort of added to the nature of our work. But the Australian economy definitely very much a service-based economy, but more and more intellectual property issues arising.
Maurice, how are you finding in terms of, specifically, as you mentioned, in terms of the high-tech industries, the relevance of intangibles, and how you may be challenged by valuing intangibles as they increase in relation to other assets that may be on the books?
Because Andrew, this is an ongoing challenge for all of us involved in business valuations because it's becoming so much more prevalent in what we do. And I think it's all a learning experience. Fortunately, in our profession, there's a lot of information, there's a lot of research, there's a lot of academic communication. People are, presenting lots of information, which helps us because the more resources we have, the better. But as everyone on this panel would know, the more work you do in this area, the better you get at these things, the more things you see. I say I've been around a long time, and I don't like to call myself an expert, but you do because you've seen something before, not because you're smart. You've seen it so many times that you know how to do it. But with IT and intellectual property and intangibles, you see a lot of new things all the time, and it's very much a learning experience and a challenge for us.
In terms of the private companies that you may be valuing, do you find that the access to comparable data, which is quite widespread in the United States, especially compared to Canada? I'm wondering whether in Australia and in Israel, the availability of comparables, are they easily accessible, or do you find that you have to focus more in on using your professional judgment in terms of the choices and decisions you make in terms of valuing businesses?
Yeah, I think for that, Andrew, it's a challenge. I see, Professor Pablo's on the panel. He does great work, looking at international different jurisdictions for things like the equity risk premium, for the capital asset pricing model, which is great because to get some external input. But generally, it's difficult. I mean, we find that we do have to use our judgment. I'm amazed at how much data is available in the United States for private company transactions. I don't even recall all of the different sources. We, for example, have a big problem with things like, everyone has a problem with things like company-specific risk. It's a very, very, very subjective issue. But when it comes to the issue of size premium, for example, the US seems to provide something you can hang your hat on. In Australia, we don't have any of that. So many years ago, I decided that I would use the US data because I felt that the United States market and the Australian market was arguably comparable, and it wasn't, given the size. Obviously there's a big factor in size, but given the sort of breadth of these small company information, I was prepared to use that, and I've been in court and have given evidence and used, for example, the build-up model where no one's actually challenged me on the fact that I'm using US data, which is an interesting conundrum, in fact, because there's not really Australian data. In fact, just a very quick story. One of the first time I used the build-up model, when I first became aware of it, I had a case on in Australia, and we had an experts conference. The two experts were meeting. No one had ever used this before. And I used it, and the guy looked at me and said, "No one knows what the heck you've done." So sometimes you can be smart for your own good, but fortunately, it worked out okay at the end of the day. So, and I've stuck doing that. I've continued to use it, but it is a problem for us. In all seriousness, it's a real problem in Australia when valuing private companies, that you really can't go in hand over heart feeling as though you've really found a source for what you've concluded. You have to still use a lot of your own professional judgment.
Morris, based on what you said, I'm really quite surprised by how similar your experiences are down under as it is for us here in Canada, because we have the same challenges with regards to data. I was wondering, Morris, if you had any final comments or thoughts that you'd like to share with the people that are participating today.
All I'd like to say is thank you for the opportunity. I've been around, sort of peripherally with this organization for a very, very long time. And it's a great thrill for me to actually interact for the first time with my colleagues around the world. And thank you to Brian for giving me that opportunity. And I look forward to hearing everybody else's contributions. And thank you, Andrew, for your—
Morris, thank you for sharing.
Thank you, Andrew. And Morris, it is great to see you. Thank you for staying engaged, and we're looking forward to getting you more involved, rebooting our chapter in Australia and looking to expand some membership in Israel. Right, we've got quite a ways to go around the valuation world literally this morning. Next, with Romania, we have Ana Maria Ciobanu, who will be interviewed by Mel Abraham. Good morning, Mel and Anna.
Thanks, Brian. Hi, Anna. It's so good to get a chance to chat with you. I know that we're running short on time, so I'm going to jump right to it, Anna. There's some interesting questions I'd love to get into, and the first one's really around the company's business models. How's the change in companies' business models, things like digitalization or ESG factors, how is that getting factored in valuations?
Well, this question don't have a straight answer, because that would be a case by case. And we don't have yet a real case. ESG, environment, social, and governance factors are now factored in prices, market prices. There are some studies that reflected differences in returns and risk, but in terms of valuation, we didn't quantify them yet. Are like buzzwords and unfortunately are this type of buzzwords now, because as long as they don't reflect in value, they don't create the factors to determine companies to go further and implement more, not just thinking. So in our profession, we challenge this. We have these challenges to quantify the non-financials, and looking at the prices on the stock market. And we have the same experience as Morris said. We use US data. We wonder how comparable are companies here in Romania with those abroad. More developed, more conscious, more sustainable, with business models that are shaped, that considers carbon efficiency, or that are considered culture changes, and with those that are boutique and just growing up or are just in their middle age. So analyzing the business model is like analyzing the business plan in the assumption. And we notice through our analysis, by the way, I'm working to KPMG, and we made a study like this to see what is now more important in due diligence for investors. And if before pandemic was EBITDA analysis, what is behind the drivers, now they are looking at the assumptions, more at the assumption of the business model, how you create that value through that business model and to that company. What makes your value? So we should consider that this type of valuation should be more and more prominent in our way of valuing companies, looking more at how they create values.
Awesome. Then this may lead to the next question, because I think you're right. We're dealing with a lot of intangible. We're dealing with a lot of qualitative things that are coming into some of the quantitative stuff that we're doing. The intangible assets are really becoming more and more important as a percentage of company values, especially in this intellectual property age. How would this trend impact valuation methods when you're looking at your values moving forward?
I think with more challenges for us, because we use the DCF model, we use multiples, and in these models and these methods, we retrieve data from the companies, comparable companies, or in case of DCF, from the business model, business plan. So if we don't look at the intangibles behind and their proportion in the total assets of the company, we may miss the risk that comes with the sustainability of the returns the company forecast, because challenging the business plan is not easy. You are not the one that run the company, and you are just the valuer. You don't know if the culture there it's exactly the one that sustain the competitive advantage we see it now. You don't know what will change in terms of key person in the future. You assume that everything that you see now in terms of intangibles existence and reflected in the value will continue to exist. But depreciation of intangibles is high if you can't renew your competitive advantage. And I think in terms of valuation, that alpha specific premium, we do know that we can't estimate, but there are some methods, a balance we could have in terms of thinking of weighted average return of assets. How many assets, intangibles you have will increase your weighted average return of assets, and by comparison, your cost of capital, your weighted average cost of capital might say something about that.
Awesome. Thank you, Anna Maria. I know that we're running short on time. I'm going to bounce it back to Brian. I would love to maybe get some more time at some point in the future to talk even deeper about how you're using the DCF and relative valuation and some of those things. So thank you for being here.
Yes, thank you, Anna. And Mel. All right, 2 more stops around the world. Chinda, what's our time remaining? All right, we're going to make this good. And punt now to Melissa Gregg, who is going to interview Pasik Shah with our chapter in India.
Thanks, Brian.
Morning.
Morning.
So we're talking a little bit about India this morning, what the valuation looks like from a regulatory standpoint. Can you give us kind of an overview?
Yeah, sure. So the valuation industry in India is changing a lot in the last couple of years. So before 2018, in India, the valuation industry was not regulated by any government agency, or there was no separate valuation profession in India. But in 2018, Government of India came up with a new regulatory body called IBBI to govern the valuation profession in India. So earlier, any merchant banker or a chartered accountant, or who is an equivalent to CPA, could do a valuation. There was no need for a separate valuation professionals in India. But since 2018, any individual who wants to do a valuation in India needs to basically register himself or herself with the regulatory body in India, undertake a refresher course of 50 hours training, and then pass an examination to become a registered valuer in India. With this new regulation in India, we expect the industry to expand, as there will be focused individuals in India who would be doing valuation as a full-time profession compared to a part-time profession which was undertaken earlier. and also with acceptance of IFRS by many Indian companies, I personally believe that the market size for valuation professionals in India is going to expand tremendously in the coming years.
That's really good information. You also have in India a pretty big startup community, and you have outside global investors. So how does that kind of startup situation compare to the US?
Great. So this is a new phenomenon that we are witnessing in India with many global funds like Sequoia, Tiger Global Management, SoftBank are investing millions and millions of dollars in Indian companies. So we in India we have seen a company which are very similar to Amazon's and other companies doing all kind of uh, getting into all kind of industry in healthcare, technology, and other domains. So earlier in India, all the investment was done in the form of either debt or plain vanilla equity. There was no hybrid instrument in India, which created a difficult time for the global investors. Since these companies used to invest in US companies, they were used to invest in a security called as preferred stock, which was like a hybrid instrument, which had the preferences like a debt instrument, and then they had the right to convert as a common equity investors. So, citing that global practices, the Indian accounting body came up with a new type of an instrument called convertible preference shares, which is similar to a preferred stock that has been issued by US startups to venture capital firms in US. So under this type of security, the companies are basically issuing a CCPS kind of a shares to venture capitalists, wherein they get the benefit of both debt and equity. So if something goes wrong and the company gets acquired for a small amount of cash, they may treat their investment as debt and get the investments back. And if there's a home run or a good exit, then there's an option to convert to equity. So this hybrid instrument created a big boost for this venture capital firms, wherein they get the benefit of both a protection from downside and a positive return from an upside event.
So you're kind of really kind of creating new instruments to even do this process. But if we're looking at traditional valuations, what do we normally see in like a discount for lack of control or a discount for lack of marketability? How are you developing those at this time?
Yeah, it's pretty interesting in India. I think everybody would be aware that what's the importance of discount for lack of marketability and control for transactions in privately held companies. There is obviously a lack of marketability, which is affected by two factors: transaction time and transaction cost. So, in a for a company that is operating in a seller's market, the transaction time may be more because they may not find buyers, and the cost of transacting may be pretty high. There may be opportunity loss of time and efforts, and then there's obviously legal fees and other fees. So typically, across other geographies, we have seen approaches like restricted stock studies or quantitative approaches to quantify the law. Unfortunately, in India, there are no statistics to support the law, and the practices that big four firms apply in India is they don't apply a separate discount for lack of marketability for transactions in privately held companies. The way it is considered is basically increase the cost of capital. Since in India, most of the valuations are still done using discounted cash flow analysis. So for a company that is just starting up, the valuation appraisers would tend to increase the discount rate by applying an additional company-specific risk premium and not apply separate discount for lack of marketability. However, as the Competition Commission of India has mentioned in its guidelines that 15% discount for lack of marketability can be applied, but in our experience, we have not seen that been applied by any big four firms. Now, with respect to discount for lack of control, here is one leverage which is provided by the regulatory bodies. So, unlike the company that we see in US, discount for lack of control is pretty high in India. Sometimes it ranges between like 20 to 40% for a certain type of transactions. Even for companies that were publicly traded, had a implied control premium of 18 to 20%. So we see a range of around 30 to 40% being applied for most of the privately held transactions, wherein a minority stake is being acquired by the acquirer.
I think it just consistently, the speakers today have really shown how if you're going to practice in different countries, you really need to know the landscape, the regulatory situation. So we really appreciate that information today. Thanks for joining us this morning.
Thank you,
Thanks for
Apostle.
having me, everyone. It was great to be a part of the webinar.
We're happy to see you. We're now going to have Alina have a conversation with Dr. Pablo Fernandez, joining us from Spain.
Thank you. I'm really happy to be interviewing Pablo Fernandez today. Hola, Pablo. ¿Cómo estás?
Hola.
It's so nice to meet you and to have you today. So we don't have a lot of time today, but hopefully we can have you in the future with us. I'm just going to go over just one question that I believe is really important if you are an expert witness. So how do you explain to judges that some valuation methods make sense and others do not?
Well, I tell judges the same thing that I tell students in class, that to value a company is basically the same process as valuing a farm of cows. And how do you value a cow? You can only do basically two things. One is to kill the cow and to sell the meat and to pay the vet, to pay some local taxes, all these things. That this for the company is liquidation value. And the other thing is to keep the cow and to value the cow depending on how many liters of milk do you expect, the quality of milk, the quality of the little cows that she will have in the future, and this is discounted cash flow. No, all the other methods are rubbish because and these judges understand well, and students also understand well. No? And I don't tell the judges, but I tell the students, and tell me another method that makes sense. Well, I say a farm with cows because, well, in a farm with cows, it's as companies with different businesses that, of course, some businesses have more value liquidated than in a continuing basis, and some others are better to continue. No? And normally companies have a mix of the two. Some things that is better to liquidate, and other things that is better to keep and to continue with them.
I love that analogy. And are you having also issues with comparables in your countries in terms of using it for your reports, or it's easier for you to find it in?
Well, I normally do valuations also, but what I do normally is to criticize valuations. No? That is much easier and much quicker. And the things with comparables is that there are very few, when they say comparable companies, you find very few comparable companies. No? Normally in reports, what you find is many companies that they are either in the stock market or some transactions that have been done, but they are in the same sector. Well, the sector normally is because they appear in some list, in some database. But if you compare a little closer, you find very different expected growth and very different past growth, and normally all the comparables have to do a lot with growth, and also many differences in risk. No? That some companies are very riskier, either because the managers are a little mad, or well, many other reasons, that they operate in countries that the government who knows what is going to happen tomorrow and things like that. And in fact, you find very, very few comparables, no? And normally taking the comparables that normally they are used by investment banks or by consultant firms, saying, well, normally it's very difficult to find more than two companies that are more or less comparables, and using those comparables, typically you get results that are very different from the ones that that the consulting firm or the investment bank is claiming that he is getting.
Thank you. Thank you for your time, Doctor.
Yes, we're so glad that you joined us this morning. Are we close to time? Great. 5 more minutes. Wow, we have made a tour around the world, and we are coming short on time, but we will have Stephen White interviewing Andrew Newman from our chapter in Canada.
Good morning, Andrew.
Hi, Stephen. How are you this morning?
I'm doing well. So this is going to be the lightning round. I feel like I have a host of questions I want to ask you, but I'm going to start off with something that's been a hot topic, the Keystone Pipeline cancellation. So tell us about the implications in Canada, as well as far as the Keystone and the M&A activity from the aftershocks of that.
And let's not forget, we got a short time, Andrew.
That's why I said lightning round.
Let me start with something that my mentor taught me about 40 years ago. And there was a Chinese word that meant both chaos and opportunity. And I think we can walk away from that, from the Keystone experience on that basis. What's most obvious is that the first fallout happens to be is a loss of jobs along the route where the pipeline happens to exist, and the implications to people that were supplying resources for the pipeline. Initially, in the American news, what it had mentioned is that there'd be 10 to 15,000 direct jobs affected. But if you look at it from an economic perspective and consider the multiplier effect, which typically is accepted to be about a 7 times factor, you're probably looking at closer to 100 to 150,000 jobs. And typically these are higher paying jobs in terms of people along the route. So what this is causing is a shift in resources, both in Canada and the United States. So there are winners and losers with chaos and opportunity. The losers are clearly the people along the route of the pipeline. The winners happen to be railways and other transport companies, because the crude is going to get to market one way or the other. An example of that is the Kansas City Railway just sold recently to the Canadian National at a major premium. The deal was over $1 billion for the railway, because they're going to transport that crude to market. As well, trucking companies are going to benefit from this in a major way. Unfortunately, the losers are going to be the consumers, because having oil shipped by rail or truck is inflationary. And the refineries are still going to make sure that there's an equilibrium in terms of the monies that they earn. The other aspect is that there's, which has been less expected, is because of the negative implications of crude in Alberta, and Saskatchewan, there's been a major shift in technology to clean up the crude, which has been an opportunity for high-tech firms in its own right. There's also been a shift in capital, which we'd have to look at, but we have to consider the culture in some of these major companies as well, and in terms of what they are doing to maximize their opportunities in the marketplace. So
thank you so much.
Yeah,
that gives you some idea, top level.
No, it does. It does. And we're going to have to invite you back, because I would like to do a deeper dive into that. And there's, like I said, I had a few other questions that I want to ask you, but I'm going to turn it over to Brian now. Thank you very much for your time this morning.
Fair enough. Have a good day.
It was very interesting. The word culture came up through a lot of the commentaries that was made by our guests. And I'm proud to work in an association and help build an association that's global, bringing in cultures, analysts, issues from around the world. And we noticed that this morning by having our members and guests from India, Australia, Israel, Romania, Canada, and also Spain. Thank all of you for joining us in your time zones while we're here up at 8,600 feet above the earth. All of you joined us this morning in your various time zones. Thank you. We're going to take a quick break and reconvene with our plenary sessions this morning. Roger Grabowski and Chris Mercer to continue this awesome conference. Thank you for joining us.